Welcome to the deep dive. This week, we're digging into, well, a really contradictory time in crypto, that last week of October 2025. Our sources cover this dramatic clash where, the price charts were saying one thing, doom and gloom, basically.
Yeah, absolutely.
But the institutional action, it was screaming like full steam ahead. And if you were watching the markets, you saw the big headline, Bitcoin's Uptober streak just vanished. That 7-year pattern gone.
Right.
It was a huge psychological hit, I think, for a lot of people.
It really was a decisive stall, and it didn't feel great. But here's the paradox, the thing we really want to unpack for you today. While Bitcoin finished the month down, the actual structural foundations of the crypto economy, they were booming.
Okay.
The smart money wasn't running for the exits they were building. Our sources this week really confirmed this rapid acceleration in real institutional infrastructure.
So we're focusing on two big trends that really show where that capital's flowing. Real-world asset tokenization, RWA, and this kind of quiet but massive shift in the U.S. around institutional custody rules. Regulatory stuff.
Yeah, the plumbing and the rules. Our goal here is to just cut through all the noise, the FUD from the price action, and give you a really clear view of what's actually driving growth. These are the things that will define the market for the next, 5 years, not just the next 5 weeks.
Right.
So we'll look at the market stall, break down that RWA engine, and get into the details of these, frankly, landmark regulatory changes that are really opening the gates for traditional finance.
Okay, let's start with the obvious, the price. That's what most people see first. Okay. Bitcoin closed October down about, 3.6%?
Yeah, around 3.6%.
Broke that Uptober thing.
Where it broke the streak. And it basically just sat there, consolidating around that key $110,000 level. I think, honestly, a lot of folks were surprised it just stopped dead there at 110K. So now analysts are kind of pinning their hopes on November, which historically is Bitcoin's best month. Yeah. They're looking for a recovery, but what's interesting is how that weakness in Bitcoin sort of spread out, especially hitting Ethereum. ETH also saw some serious consolidation.
Yeah.
It couldn't break that really strong resistance near $4,000. And you got to understand why that 4K monkey number matters so much.
It's more than just a number, right?
Oh, absolutely.
Yeah.
It's not just, a nice round figure. It's a major technical and psychological barrier. Until ETH can really push through $4,000 with conviction.
Then the rest of the market struggles.
Exactly. The broader altcoin market, the higher risk stuff, it just struggles to find any real sustained momentum. ETH is still kind of the anchor for broader optimism there.
So, okay, the two biggest assets are kind of stuck. But if you look at where some, let's say, influential money is actually being placed, it tells maybe a different story about confidence.
Right. There were some interesting moves.
Our sources flagged that CZ Changpeng Zhao, major figure, he revealed a pretty significant personal investment in a project called Aster.
Aster. Yes, Aster. That's the DeFi perpetual contracts, DEX.
Okay, let me quickly unpack that. DEX is decentralized exchange.
Right, trading directly on chain. No central company like Coinbase or Binance involved.
And perpetual contract.
Those are derivatives. Basically lets traders bet on where the price is going, up or down, without any set expiry date. High leverage often involved.
So what's the takeaway from CZ investing there, even when prices are flat?
Well, it shows that, smart, influential money still believes in the long-term value and profitability of the trading infrastructure itself.
Oh, okay.
They're not necessarily waiting for Bitcoin to break $110 or whatever. They're investing in the sophisticated tools that let people trade, manage risk, use leverage, regardless of the spot price today.
So confidence in the rails, not just the current price.
Exactly. Confidence in the liquidity, the maturity of these decentralized financial systems.
Yeah.
And that leads us perfectly into the other side of this story, the institutional engine that just kept chugging along. Real-world asset tokenization.
RWA. Taking traditional stuff, bonds, real estate, maybe even equities, and putting them onto the blockchain.
Precisely. And by the end of October, the total market cap for these tokenized RWAs hit $35.66 billion.
$35 billion. Okay, that number's starting to sound pretty substantial, but is it really critical mass? Or is it still kind of small compared to, the trillions in traditional assets globally?
That's a fair question. What makes it critical isn't just the absolute number, though it's growing fast. It's the rate of growth.
Right.
It was up 8.77% just in October, month over month.
Wow.
That acceleration tells you the plumbing is working, the legal stuff is getting sorted out, and the big institutional players are finally starting to scale up their RWO offerings. So yeah, I'd say RWA is clearly the #1 institutional growth narrative right now, late 2025. It's reached that like minimum viable size for the big asset managers to really dedicate serious resources.
And we saw some evidence of that confidence in the plumbing itself, as you called it. The on-chain data showed whales
Yeah, those big wallets.
accumulating huge amounts of Chainlink's token. Almost 10 million Link, worth about $188 million, pulled off exchanges.
That's right. And you have to think about why Chainlink is like that foundational layer, the critical digital infrastructure.
The Oracle network.
Exactly. It securely gets external data like asset prices, proof of reserves, things like that onto the blockchain so smart contracts can use it reliably. So when you see whales stacking Link like that, pulling it into cold storage, presumably,
It signals a long-term bet.
it signals they're betting on the whole RWA narrative, needing that secure, verifiable data. They need Chainlink to make these tokenized assets trustworthy and, legally sound. It's not just a quick flip, it's an infrastructure investment.
And this RWA boom wasn't just happening on, say, Ethereum. We saw Stellar put up some really impressive numbers, too.
Yeah, Stellar is a great example. They reported over, $5.4 billion in RWA transaction volume.
$5.4 billion.
And Stellar focuses heavily on institutional cross-border payments and tokenizing assets, often using stablecoins and regulated digital money. But the really telling number for Stellar
Wasn't the volume.
well, the volume was good, but the killer stat was the 700% surge in smart contract invocations in Q3.
700% in contract calls.
Yes. That massive spike tells you institutions aren't just like sending money through Stellar. They're actively building complex automated applications on Stellar.
So deeper adoption, real utility.
Exactly. That's genuine deep adoption for actual use cases, like automating payments or managing tokenized assets.
Okay, so this RWA engine is clearly firing, but it needs regulatory clarity to really run smoothly, right?
Absolutely. The rules of the road are critical.
And on that front, we saw something pretty significant this week from a U.S. regulator, the Office of the Comptroller of the Currency, the OCC.
Yeah, the OCC, they oversee the big national banks.
They put out an interpretive letter. It basically confirmed that U.S. national banks, federal savings associations, they can offer crypto custody and some stablecoin services. We kind of knew that, but...
But the kicker was hidden in the details.
Exactly. The letter rescinded the requirement for these banks to get supervisory non-objection first.
Okay, let's pause on that because supervisory non-objection sounds like jargon, but it's huge.
Yeah, what does that actually mean in practice?
It means that historically, banks had to basically ask the OCC for permission, get pre-approval, before starting any new crypto activity. And that process could take months, even years. It really slowed things down.
So removing that requirement.
It means banks don't have to ask permission anymore. They just have to notify the OCC, like they would for other new business lines. It massively cuts the red tape.
It basically opens the floodgates for the big banks to jump into crypto custody and stablecoins much, much faster.
Precisely. And unsurprisingly, the traditional finance lobby reacted immediately. The Bank Policy Institute, the BPI, which represents the major banks, they jumped in and urged the SEC to apply the same strict standards, especially around separating customer assets, to all custodians. That includes the crypto-native firms.
Okay, so on the surface, that sounds like, hey, let's protect consumers. But is there a strategic angle here? Are they trying to use regulation to make life harder for their crypto-native competitors?
That's certainly how it could play out. They're demanding the same asset segregation rules, the same level of ongoing oversight that traditional banks face.
Which sounds fair.
It does ensure strong investor protection, no doubt. But it also forces those smaller, newer crypto firms to meet a very high, very expensive regulatory standard. It potentially favors the institutions with massive balance sheets, the established banks. It levels the playing field, but maybe tilts it towards the incumbents.
And this tension, this sort of old guard versus new guard dynamic, we saw a really stark example with the Custodia Bank ruling, didn't we?
We did. A U.S. appeals court upheld an earlier decision, basically saying that Custodia Bank,
which is a crypto-focused bank trying to bridge TradFi and DeFi.
Right. They are not entitled to get a Federal Reserve master account.
And that master account is kind of the golden ticket, isn't it? Direct access to the Fed's payment systems?
It's the ultimate access pass. It lets a bank connect directly to the U.S. payment rails, access Fed services, without needing another bank as an intermediary. So the court basically backed the Federal Reserve stance, which has been pretty reluctant to give these master accounts to non-traditional crypto-focused banks. It's like the Fed saying, nice innovative car you built there, but you can't drive it on our main highway just yet.
So you've got this weird situation. The OCC is making it way easier for the big established national banks to get into crypto custody,
Lowering the barrier.
while the courts and the Fed are essentially blocking the on-ramp for innovative crypto-native competitors like Custodia trying to access the core banking infrastructure. It feels unbalanced.
It definitely creates an asymmetric playing field, and this focus from regulators on sort of controlling the narrative around utility and access. It's not just happening in the U.S. We saw similar moves globally.
Like in Asia.
Yeah, if you look at Hong Kong, the Hong Kong Monetary Authority, the HKMA, they announced a policy shift for stablecoin issuers.
What does that change?
Going forward, anyone wanting to issue a stablecoin in Hong Kong needs to prove they have strong use cases and real, demonstrable, real-world utility before they even get a license.
So they're saying we don't just want stablecoins for speculative DeFi trading or, yield farming.
Exactly. No more purely speculative plays.
They want stablecoins used for actual payments, for functional infrastructure, like the RWA stuff we talked about.
Precisely. It signals this global regulatory trend. They're favoring stablecoins that act as regulated payment rails or tools for institutional transactions, like settling tokenized assets. Things with clear, understandable utility.
Okay.
It lines up perfectly with that institutional focus on RWAs. Utility is basically becoming the new key compliance buzzword.
Okay, so let's try and wrap this up. We've got this clear duality, right? On one hand, a really disappointing price performance for Bitcoin, down 3.6%, breaking that Uptober streak. Looks bad on the surface.
Yep. Seems negative if you only look at price.
But underneath, you have this incredibly rapid structural shift happening, driven by RWA hitting that, $35.66 billion market cap.
And growing fast.
And powered by regulatory changes like the OCC, basically giving big banks the green light by removing that non-objection hurdle.
Right. So the market consolidation, the sideways price action, you could argue that's just shaking out the short-term speculation.
While the real work is happening underneath.
Exactly. While the deep infrastructure gets built, you see it in the metrics that matter for adoption. Those L9NK whales accumulating, stellar 700% jump in smart contract use.
Yeah.
Those signal real utility, not just hype. The institutional engine is clearly running. Whether Bitcoin is at 110K or 120K or even $100, the price is becoming less relevant to that core build-out.
Which brings us back to that core tension, that provocative question. The OCC throws the doors open for the big banks, easier custody, easier stablecoin services. But at the same time, the courts uphold the decision blocking Custodia Bank, a crypto native, from getting that crucial FedMaster account.
Creates a potential bottleneck.
So the big question for the future, the thing maybe for you, the listener, to really mull over is, are we seeing a regulatory environment being shaped, perhaps deliberately, to favor the established financial players?
Allowing them to adopt and control blockchain tech from within the existing banking system.
While potentially sidelining or slowing down the new, disruptive crypto-native firms, is TradFi co-opting the revolution by controlling the regulatory narrative?
That question of access, who gets the keys to the kingdom, who gets to build the new financial rails versus who just gets to use them under existing rules, that's probably the defining battle for the next phase of digital finance.
Definitely something to keep a close eye on as all this unfolds. Thanks for diving deep with us today.